Okay, so joining us now is Tony Zhang. How you doing, Tony?
Good, Patrick. Thank you so much for having me.
No problem. So, listen, we're looking forward to taking a deep dive into the trade wars and some of your stock ideas in a moment. But I understand that you're going to join us with a nice beverage. What are you drinking?
I'm actually going to start off with Highlight, which is a pale ale from a brewery in Tampa called Cigar City. I don't know if you guys ever heard of this. It's one of my favorite IPAs. Um, it's
Nice.
it's out of Tampa. I don't know if you guys ever make it down there, but they have it everywhere now.
Well, listen, you know what? You got to. I guess you can't really bring that up to Toronto when you're here in September, can you? But yeah, next time I'm down in New York or something, we'll have to. You have to give me the name, and I'll quickly grab one of those. Anyway, so and then what else are you drinking? You drinking anything else?
I think I will follow that up with a Balvenie peated cask. I'm a big fan of the peaty scotches, so I have two different preferences for scotches. I like the Madeira and port casks, and then I really like the really peaty stuff, so Lagavulin, that type of stuff. So I'm on the Balvenie peated cask today.
Wasn't that like a so for those of our listeners, we've been drinking before with all these different scotches when we were out in Montreal. It was one of these peaty ones that you gave me, wasn't it? Do
Yeah,
you remember what we were drinking?
we were drinking the Johnny Double Black, which is
Oh yeah, no, no, the
the
blend.
blended whiskey from Johnny
It
Walker.
was very nice.
That was from some pretty peaty stuff. Yeah, but this one's more
Wow.
peaty. I love the really peaty stuff. For those of you that like that kind of scotch, what are you
All
drinking?
right. Um, well, we're drinking. No, we're
Is-
not. We'll edit that out. What the fuck are we drinking? I'm drink. That's what I'm drinking right now.
Spotted Cow, Wisconsin.
There we go. Okay. Yeah, we're
Just
drinking.
leave it.
Lena, can you
Lena,
mark that?
don't edit it out.
Oh,
Lena.
don't
Leave
edit
it
out.
in.
No,
Okay, let's
no.
talk some markets. Let's talk
Yeah.
some markets. Tony,
Uh,
what do you got for us?
So today, I want to talk about the trade wars and the Fed cuts because, as a strategist, this has been a bit of a challenging environment to trade. We've had these periods of extreme calm followed by these violent corrections. We saw that in December 2018. Are we starting to see some of that again? Is kind of the question. And we really want to talk a little bit about this ping pong that we're currently seeing in the markets between the Fed cutting interest rates and then immediately Trump slapping on some tariffs. And the question is, who wins in all of this? Is the Fed cuts stronger and will bring markets higher, or do the tariffs, hurt the markets further and bring us, lower? So that's what I want to discuss here today.
Right. And so we have this chart here up on the S&P. So you're just trying to show the levels here, right?
Yeah, I think 295 was kind of that line in the sand prior to the sell-off. The fact that we managed to get above it was certainly starting to look like we were getting back into a bullish phase. And then, we had this correction back below it, this violent correction. We got a whip back up to that 295. Looks like that got rejected as of yesterday and today. So, I really think that this is probably headed a little lower, at least down to that 272, 260 level. Our potential targets is the downside for the short side, for the short run.
Right, right. And so, what's your thinking here? Like, what do you think of this mid-cycle adjustment language? Do you think that there's more rate cuts to come here?
So yeah, I actually have this in one of the next slides, but this I believe is the first of many rate cuts to come. The market is already pricing in at least 2 to 3 more rate cuts between now and the middle of next year. So I definitely think that that's potentially coming down the line. This was the first rate cut we've seen since 2008. During what is relatively strong economic times. Which is not something that we typically see.
Right, right. And so, what's your thinking here on the trade war escalation, though?
So, what I find kind of scary is the fact that, the second the Fed cuts interest rates and potentially provides a boost for the markets, Trump comes in and raises tariffs. And he's been doing this almost as or he has been doing this as a way to get China to bow to his demands, if you will. And this is a dangerous game because, as you can see here on this chart, we've got this massive escalation of tariffs. In September 1st, we have potentially going up to 6%. And the fact that this is across consumer goods is kind of the scary part in terms of what's next. Are we talking about more tariffs? Are we talking about tariffs for Vietnam or even automobiles? These are things that we've kind of left off the table. But, in this trajectory, I think anything is possible. And I think that's really the scary part that we're heading into.
Right, and then so you were looking at that from like a feedback loop mechanism, where is this the game that Trump is playing in your mind, like in terms of when he's making the choice for putting these tariffs on?
Well, I certainly think the timing of these round of tariffs were. I don't think it was a coincidence that it was announced right after the Fed cutting interest rates. So yes, we're seeing this feedback loop, and this is really the dangerous thing that I want to talk about is the fact that when the Fed eases, we get this feedback loop. And if you can move on to the next slide, I'll talk a little bit about what this looks like. So right now, the trade war is continuing to escalate. Right now the concerns are whether or not we're going to get higher tariffs across more goods, and even in countries like Vietnam, where a lot of that trade is shifting to. And the fact that the market is pricing in more rate cuts. So does that mean that Trump is going to potentially put in more tariffs? And that's kind of the thing that I want to take a look at. And I think the best way to take a look at this is kind of cutting out the noise and actually looking at some of the economic data that I think the Fed is really looking at to make their decisions.
Right. So what do you think are some of those major inputs in your mind?
So, if we look at it globally, things are certainly slowing down, right? If you look at GDP pretty much globally, things are slowing down. US, China, Britain, for a lot of emerging market countries, we're seeing some slowdown on here. In the US, non-farm payrolls, we're really starting to creep down to that 2013 level, which we haven't seen for quite some time. Businesses are more cautious about investments. A lot of the industrial indicators are particularly weak. So if you look at the next slide, global automobiles are near all-time lows since 2008. These are all things these are not, in my opinion, showing any form of recession per se. And the next slide is another indicator that we typically look at. The 10-year, 3-month Treasury yield has certainly gone negative. Again, these are all signs. It doesn't mean that things are it doesn't mean that we're in a recession, doesn't mean necessarily we're headed into a recession, but it simply just means that everything is slowing down. And the next slide, I have one on GDP. We had a recent revision for last year's GDP from 3% to 2.5%. That's a pretty big move to the downside. So if you look at the downside risks of a recession on the next slide, well, that's certainly ticking higher. So these are all things that are kind of that we're looking at that suggest that it makes sense to potentially. Or what we're seeing is that the Fed is really trying to get ahead of this and this slowdown, and that's why they're cutting interest rates. But with Trump throwing tariffs here in the wrenches, if you will, this is really what is concerning, at least for me. I don't know what your thoughts are about this, but I think the best way to really look at this is actually thinking about game theory. I don't know if you guys ever have studied game theory, but it's very clear to me that the global trade game that we're all trying to play is clearly an infinite game, meaning there's no winners in a global trade. It's whoever can survive the longest, and the winner is really the person who manages to stay in the game for the longest. And Trump is clearly not playing that game. He's playing a finite game. He thinks he can win this game, and there's no such thing as winning this game. And China seems to be on the other side. China seems to be playing this long game. They're playing it slow. They're not taking any shots. They're waiting for Trump to do something before they do anything in return, and they kind of, I feel that they kind of feel they see that as long as they continue to just wait it out, that it's likely that Trump is actually going to hurt himself from the perspective of, more tariffs are going to hurt the markets, which are going to hurt his chances of being reelected. And at the end of the day, he can only be in office for another 6 more years, which obviously is a very long time. But I think China is thinking the long game here.
Right.
But Tony, it's Kev. I'm going to jump in here. But haven't the Chinese kind of noticed that the tide has shifted in America? And whereas before it was only Trump that was behind the whole idea of worrying about the Chinese situation, we're seeing more and more the Democrats and other political parties grabbing hold of the idea that China's not playing fair, and the idea that you might wait out Trump is no longer kind of an actual outcome that China might be able to do.
You're absolutely right. And, and there are certain things that China have done for a very long time that I don't think America should allow, such as all the theft of intellectual property, right? That's always been a very, very big problem. But has China moved or budged on that at all? I don't think so. And this is really the part that I'm concerned about, is whether or not, China has any interest in really responding to that.
So now, if that's correct, and they don't have any interest, and Trump is going to continue to escalate it, do you think it resolves itself with a market crash? And if there is, do you think it hurts China more than the U.S., or just there's nothing but losers all around the table?
So my point is that I actually think that in this particular case, it's really everybody loses. These two world leaders are fighting with each other, and at the end of the day, we all lose, right? And the scary part is the fact that central banks across the world are responding to this, right? Just in the last few weeks, we've had the Philippines, we had Peru, we had India, Thailand, New Zealand, all cutting rates. This is unprecedented in the fact that if you look at Germany, look at Switzerland, all of their bonds are negative yielding already. And this is when things are okay. So what is going to happen when things really hit the fan? We're going to cut rates. We're going to cut rates to zero. We're going to go into QE. Historically, we've cut rates by about 5% going into a recession. Now we're already at 2%. So where do we go? Do U.S. interest rates become negative across the entire curve? I think I don't think that's necessarily a high probability, but I think that's actually probable. That's something that we don't have a textbook for. What if all U.S. bonds were all negative yielding? What do we do then? I don't know.
Well, Patrick would be taking us all out for dinner because he'd be loving it so much.
Why, is that something you predict?
Well, not necessarily negative interest rates, but I think interest rates are going much lower. Gravitating to zero, I think, is the better way of saying it. I don't know if I'm going to drink the Kool-Aid that we're going to see negative in the U.S., but anything's possible, I guess. But
Patrick, you're not bullish enough, buddy. You're not bullish enough.
Oh, there you go. So I'm going to ask you this question though. All right. So I mean, Tony, you were kind of straddling the line as to non-committal. So I want all three of us an over/under binary, yes or no. Is there a recession before the elections next year? Starting with you, Tony. Yes or no?
I'd say yes.
All right, Kevin.
Yeah, I actually am in. Yeah.
Oh my God, we're all in consensus. This is gonna be awful.
Yeah, it won't happen.
So listen, everyone. There's no recession coming. Whenever we all agree, it's do the opposite.
Yeah, and I don't want to be this doom and gloom kind of thing, right? On the next slide, I do want to talk about positioning, right? So when I'm a big fan of relative strength, I use relative strength very heavily in my trading in terms of understanding where to position. And still, domestic equities, U.S. domestic equities, still is the strongest asset class in the whole world right now, above international equities, fixed income, everything else. We do see cash starting to become slightly more, or not the least, or is not the weakest asset class anymore. So, I do think that it's time to start positioning into slightly more cash, especially in some of your non-performing assets. And I do think that it's time to start thinking about buying some puts or hedging for your long equity positions. I don't like buying puts ahead of time, trying to anticipate, a downside. But I do start, the fact that we cracked below that 295 level, this is telling me that, this is time to start looking at those types of trades. For as far as a hedge goes, I always say it's better to be late than early, because if you buy puts early, you're going to end up creating a huge drag on your portfolio that's very expensive. Wait till the markets start correcting before you buy puts. It'll be expensive, but it'll be worth it.
All right. So you're basically saying pay the higher vol premium, but be late, right?
Exactly.
That's interesting. I have a little bit of different philosophy, but I mean, that's what makes a market, isn't it?
Yeah.
But that's interesting. So you have some other trade ideas for us in terms of sectors. What's on your mind?
So as far as, if you look at the fact that I'd love to get into marijuana stocks, but I just have one thing to say about where I think there's still some opportunity, with respect to the trade war, right? Because this last set of tariffs is specifically targeting consumer goods, and consumer goods is really the one bright spot that we currently see in the economy, out of the economic numbers. Consumer retail has actually been really, really strong. So if you look at the stocks that have exposure to China versus stocks that don't, I really see some bifurcation that you have potentially opportunities on retail sides, on the retail side that have sold off the last few days, that have a fairly small amount of exposure to China versus the stocks that have a high amount of exposure to China. So those are some of the opportunities that I currently see going in the market. With that, let's jump into marijuana stocks.
All right. So what's on your mind here?
So I was just looking at a marijuana index, and I saw that, we're starting to see a bit of a bottom forming out in marijuana stocks, because we've really had this huge sell-off over the last pretty much 6 to 8 months in marijuana stocks. So pretty much across the board, growers, distributors. The only bright spot really has been kind of on the Scott's Miracle-Gro, like the fertilizer companies, some of the pharmaceutical companies. But if you look at any of the major cannabis companies, they've all had this huge sell-off. And the question is whether or not we're starting to see a bit of a bottom. From a chart perspective, we're starting to see higher lows, which is the first thing that we typically look for a potential bottom. And the question is looking at some of the fundamentals and looking at legalization in Canada as to see if this is starting to become the bottom or starting to become a bit of a turnaround for this market. You guys are in Canada. What do you guys see? Do you guys see people lined up? Last time I was up there in Montreal, I think a couple of months ago, there were people lined up out the door to buy cannabis. Is that still kind of the trends that you guys are seeing up there?
Well, no,
most
people just use their. Yeah, sure, Patrick. Most people have their dealers, and actually, the interesting thing that's occurred is that the reality is that the legal cannabis market in Canada has not grown nearly as much as everyone would expect, because first of all, the quality hasn't been that good, and the reality is that the private unregulated market is actually that much better. It's been the kind of the strangest thing around. It has not done nearly as well as everyone would have hoped.
Right.
Got it.
But where it is interesting, we have in Canada the Horizons Marijuana Life Sciences ETF, which is the Canadian dollar basket for these cannabis stocks. And we're approaching lows that were established all of last year. Like with all through 2018, we saw this particular ETF testing this kind of $14 to $16 range. So we're definitely approaching what has in the past acted like a support. Will this be a turn point? It's certainly no longer near the highs. So it's gotten beaten down almost. Yeah, it might be interesting. What is there particularly something that you're watching within that space?
So what we're seeing is that there's been a lot of headwinds over the last few months, right? So just in June and July, we had some pretty big news come out that were quite bad for the industry. And the Hexo announced that margin and price compression, which is not new at all. This is something that the marijuana industry has been experiencing, I would say, over a year plus now, where just prices have been continuously declining, margins have been declining, and Canopy announced a big earnings miss in June. July, we saw the CEO of Canopy, the largest manufacturer, get pushed out, which was certainly not necessarily great for the industry, but probably good for the financials of that company. And Canatrust having that illegal grow facility certainly wasn't good for the industry. So these are all headwinds that we kind of saw that kind of decoupled this industry from the overall market, because for the most part, marijuana traded in line with the overall market until the last few months. In August, we started seeing some earnings beats. So the question is, are these early, smaller companies that beat earnings, is that kind of a bit of is that the beginning of a turnaround for some of the larger companies? And what we saw is, Aurora actually they didn't pre-announce. I don't know what they issued a guidance about a month before their actual earnings. So I think their next earnings is on September 11th, actually. And they just announced last week that, they gave some guidance that were really strong. And we saw the stock pop as a result of that. Some of that has come off over the last few days. But, really what we want to look at is kind of the big companies and kind of what we're expecting in 2020, because Canada just released the rules for, if you will, going forward for edibles and vapes, which is kind of the higher margin products. Those are the products that the companies really want to sell. The flower, like you said, the flower is more expensive and it's not as good. But the edibles, the vapes, those are some things that generally speaking are not as accessible on the black market. So those are some of the, I think, what's going to provide some more opportunities in 2020. Patrick, if you don't mind, just moving on to the next slide.
Yeah.
So what we started doing is we started digging into some of these marijuana companies. This is just a quick report that we put up together just for ourselves, because doing research on marijuana stocks actually wasn't that easy to know which stocks were even in this category. Because you kind of span everything from the tobacco suppliers that have invested in some of these companies, to the actual growers themselves, to pharmaceutical companies, to companies that provide resources or provide fertilizer to this industry. So there's a lot of different stocks. So we wanted to take a look at the overall industry, and we started to see some interesting trends in terms of stocks that are starting to go above its 20-day moving average. So one of the things that we really see is for 2020 on the next slide is that clear 2020 regulations is good. Clear regulation is good for the industry. It lets people understand as far as what is the potential, because there was a lot of uncertainty around edibles, how the Canadian markets are going to regulate that. I think there's still some uncertainties around how edibles will be in Quebec, but for the most part, there's been rules that have been established, and that's great. And it brings these higher margin products. But compliance with these rules tend to favor the larger players. So if we look at Colorado as a roadmap and trying to see the adoption and growth there, a quarter of the residents there are consumers of marijuana, which is a very large percentage of the residents. Now, even if we apply a fairly conservative approach to that for Canada, we see a lot of growth going into the next 5 years. Colorado saw about 100% growth over the past 5 years. So, as far as the companies that we look at, Aurora and Canopy clearly are the leaders in this particular space. And we think that those are the two companies that will really be able to take advantage of the growth over the next few years. And we think that some of this turnaround was probably going to happen by Q4 this year, Q1 of next year, where these companies that have large amount of scale will really be able to take advantage of the legalization in Canada. Aurora has established a fairly large footprint, and I think they're going to do fairly well over the next few years as legalization continues. They've provided strong guidance, which is, kind of the shift that we're starting to see towards the upside, that the largest or the second largest cultivator in Canada, and they've really expanded globally. So we really see that there's quite a bit of opportunity from that stock. Canopy, same thing. They have the largest scale. We think they're the best capitalized, and they're really going to be able to capture the legalization in both Canada and potentially in the U.S. Canopy has really made some acquisitions within the U.S. space, like Acreage Holdings, that allows them to have a huge footprint within the U.S. if the U.S. was to, if the U.S. is to legalize it on a federal level. But we see some smaller players like Canna Trust, which I in this particular case is a smaller footprint. There's no real international expansion. We don't really see that as an opportunity. But Hexos has a pretty big distribution within Quebec, so we think that they can do quite well there as a small player in this particular space. And lastly, Kronos. Kronos has their partnership with Altria Group. They have a significant amount of cash on hand, and I think if they deploy that well with some mergers and acquisitions, they can really become a leader out of the smaller companies currently. So that's kind of the landscape that we're currently seeing.
So, Tony, I have to ask you, though. I'm sure many of our listeners are asking that same thing. Now, you're a big options guy. Do you particularly express these trades by buying the underlying, or do you use some sort of an options way to play this?
So my preference for these types of longer term plays is actually buying somewhat in the money leaps. They're expensive, but they're certainly cheaper than buying the underlying. Many times you can get about a 4-to-1 leverage on these fairly still expensive stocks to purchase using calls. But buying leaps, I think many times are a good way to get that upside with limited risk of the downside, because these stocks, we have seen these 20-25% pullbacks. Or potentially even larger pullbacks. So right. to offset that risk, I think a good way to play this is slightly in the money leaps, I think is the best way to play this.
Nice.
Okay, well, Tony, that's some great stuff. Thanks for joining us today. Before we let you go, why don't you tell people where they can find a little bit more about what you do and what you offer, and where they might reach out to talk to you more about this?
Yeah, so again, thank you guys so much for having me on. This has been a great pleasure to talk about the markets while having a drink. Not something I get to do very often. But my name is Tony Zhang. I'm the chief strategist here at Options Play, and we run a company to help individual investors better understand and educate you on how to trade options. You can find us at optionsplay.com, but I do have a special link here at the bottom that allows you to sign up for a free 30-day trial to Options Play, as well as get a free 12-step options trading course to help you get started. So if you're brand new to options trading, or if you're an experienced options trader, we've really designed this from the ground up to either make your options trading experience as simple as possible with respect to learning the beginner stuff, or if you're an advanced trader, we try to make your user experience of finding a trade down from a few minutes down to just a few seconds. So please visit us. Nice. And if you have any questions, send me an email, or just sign up for a free trial at that link.
That's terrific.